Hello, Pacific Bitcoin. Thanks for being here, guys and ladies. We got two excellent guests on the panel right here. I'm Sam Callahan. I'm the lead analyst at Swan Bitcoin. We have Preston Pysh, who needs no introduction. He was here last year, and he has a small podcast you might have heard of. And then we got Zagury, who is the chief investment officer at Swan. I wanted to kick this off actually by introducing you guys a little bit to Rapha, because you guys might not know him, but I find people like him fascinating because he has a Wall Street background. He has worked on Wall Street for many, many years, but he discovered Bitcoin, and now he uses his experience and talents to push Bitcoin's adoption. So, Rapha, what made you come around to Bitcoin, given your experience on Wall Street? Because a lot of people in your shoes, they have a hard time kind of seeing the value proposition of Bitcoin.
Yeah, I try to hide as much the fact that I came from Wall Street as I can, but I guess that's out there. It's not very popular with this crowd usually. But yeah, I think that what really got me to Bitcoin started, as early as I started my life. I was born and raised in Brazil. I lived in Brazil in the 80s. We had hyperinflation. And when I mean hyperinflation, it's really hyperinflation. Like, I would get money from my mom at night. Like, okay, here's the money. You're going to use it tomorrow to buy things at school. Don't bring the money back, right? Because if you bring the money back tomorrow, it will be worthless, right? So I always had that part of like the money is broken, and there are ways that the money can get broken very easily in my mind. Then I was very lucky also when I went to university. My university, very luckily, they actually taught macroeconomics, two different styles. So you learn Keynesian macroeconomics, and you also learn Austrian school of macroeconomics.
Oh, wow.
So that also got me exposed. And above all, I've been a technology enthusiast for a long time. I ran a BBS in the 90s. I mean, always loved technology, always loved coding. So Bitcoin, I think, for me, came naturally, but I think that also proves and shows that how hard it is for people to actually get Bitcoin, right? Because unless you have a series of experience, which I was lucky enough to have, it's very hard for people to really grasp and grok Bitcoin at the end of the day. And just very quickly, I worked at major Wall Street firms. I worked at Goldman, I worked at Merrill, I worked at Deutsche, doing all kinds of trading, traded pretty much every different asset class, traded derivatives. And I tried a couple of times to tell people about Bitcoin. I remember in Deutsche Bank trying to present for like an annual investment committee about Bitcoin in 2015, and that didn't go well at all. Magic internet money, governments are going to ban it. I heard all of it in like three minutes.
Yeah. We'll certainly get back into your experience growing up in Brazil. And it's not hard for people like you to understand the value proposition of Bitcoin, having lived through hyperinflation. But we all know on the stage and a lot of people in this room that the money is broken when we look at the problems of society. And really it comes down to the debt that we have right now and how everybody has to rely on being almost debt slaves. And Preston, I've heard you say that before. And we had an alarming historic milestone where the public U.S. debt crossed $33 trillion. And just yesterday, they added more than half of Bitcoin's market cap in one day to the debt. And so, Preston, right now the bond market seems to be on fire, so to speak. Yields are rising. I've heard you talk about the bond market so many times of how, hey, this is the value that's eventually going to end up in assets like Bitcoin. Look at this giant mountain of debt. And so right now, yields seem to be spiking. There's a lot of narratives around this debt crisis. How are you seeing things right now in terms of the bond market?
I think most are familiar with just the bond market in general, and they're looking at these yield curves, and they're seeing the yields go higher, which means the bond prices just keep going lower. And if I could rewind back to the Silicon Valley Bank situation that happened earlier in this year, the response that the Fed had was effectively yield curve control, but it was only yield curve control for the banks. If they actually wanted the deep recessionary, deflationary forces that were brewing through that event to occur, which would have brought the recession/depression if they continued to keep their hands off of the controls and not done anything. They would have taken whatever inflation was at that moment, and it would have been deflated completely out of the economy really fast, because that's how the fractional reserve system works. So they didn't want that to happen. They want everybody else to experience the inflation, to deal with all that, so that they can not just have the banks fall apart and collapse, but for everybody's buying power to contract, so that they can try to keep their hands on the controls and in some semblance of the controls from 7, 8, 9% inflation of what we are dealing with. So what I think you're going to continue to see in the market, going to your question, is you're going to continue to see them use surgical tools like the backstop facility that they use, which is effective yield curve control, but only for the banks.
Yeah.
They're going to be much more surgical. I'm curious how Rapha sees it, but I think they're just going to continue to be more surgical in the way that they implement things, whereas before it was just QE for everybody. We can't manufacture inflation whatsoever. And they did that for a decade plus, until now we're at a much different situation post-COVID, where all these effects are now really kind of manifesting themselves in a very systemic kind of way into the economy.
Yeah, I mean, Rapha, we saw, like what Preston is alluding to here, the BTFP program come out in the midst of that banking crisis. And even today, the unrealized losses on those banks' balance sheets from those bonds are over $400 billion. And it's not just the banks, though. It's also other institutions like pensions who hold a ton of these bonds that are underwater. You, in your position at Swan, you actually speak to some of these institutions, and you kind of advocate for Bitcoin to add to their portfolios. I mean, what kind of conversations are you having, and how do you think this plays out going forward with these surgical interventions that the Fed's doing?
Yeah. I'll use the example of pensions. I think that's a good one, because we've had a few discussions with pensions recently that I think show the size of the problem and how it actually impacts people at the end of the day, right? Because if the pensions are not going to make it, people are definitely not going to make it, right? So it impacts individuals at the highest level. If you look at the way that pensions have created their portfolio in the last 2 decades, right? They've been looking at interest rates being very, very low, because of the Fed, and they've been looking at alternatives, right? So what did they do? Well, first thing they did, they extended the maturity. So instead of going short, they're having fixed income that was 1 year, 2 year, 3 years. They went to 10 years, they went to 20 years, they went to 30 years. In some cases, they went to 100 years, right? Which is just mind-boggling, but there are 100-year debt out there that some of these pensions hold. Then, even with that, they couldn't get enough yield to satisfy the liabilities that they had. So it's okay, we need yield. We need to generate yield at the end of the day. So what we do, let's go a little bit up on the risk spectrum. So instead of going to fixed income, let's go to real estate, right? Yeah. Let's go to equity. Let's go to private equity. Let's go to venture capital, right? And that just kept going up. And the bill is coming, right? Now they have to pay for all this risk that they take. The duration risk that they took in fixed income, that's the easiest one to know, because rates go up, prices collapse. If you have 30-year duration in a bond, your price is going to collapse significantly from where you are. So the mark-to-market of a lot of these pensions are actually coming down. And you would say, well, but rates are higher now, so it's good. Yeah, it's good, but the mark-to-market of everything that they have outstanding is coming down, and they have a lot of the liquid assets that they built along this time that they have to unwind in some sort of way. So it's a massive problem, right? At the end of the day, they have to match liability to their assets and to their assets income, and it's just becoming harder and harder for them to do, right? And I don't think that's turning, unfortunately, anytime soon. I know what the solution is, right? The solution is that they have to look somewhere else. The base layer of what they're doing is broken, right? The money is broken, the incentives are broken, so they have to find something else. I think everybody here knows what that something else is, but it's going to take time for some of them to get there. Very interesting, just very quickly, I'll mention something. Dom Bay actually had a great idea a few months ago It's like, Rafa, you have Nakamoto portfolio, you have all these asset allocation tools there. That, by the way, we've developed exactly with the mindset of having these discussions with pensions, endowments, ultra high net worth clients, and showing them how Bitcoin fit in their portfolio. Said, why don't we start going to the pensions and we show them what the impact of Bitcoin could be in their portfolio, right? So we've been having these discussions, and it's quite interesting. I think, I'm very surprised that a lot of them are actually open to the discussion. They want to understand. And at the end of the day, it's a matter of sizing, right? Should these guys have 10% of their portfolio in Bitcoin? Definitely not to start with. Ultimately, yes, but to start, not. But have 1%, 2%, 3% makes huge sense, and already can have a significant impact on their portfolio, right? So I think when they can see that in numbers, right, and in how it actually can reduce the volatility of their portfolio, which is surprising, but it does, right, and increase the returns significantly, it just makes a lot of sense to have these conversations.
One of the things that I think is important when people are listening to these conversations about bonds and like all this financial jargon, for people that are buying Bitcoin and they're not intimately familiar with financial markets, they might look at it and be like, well, over the last year and a half, Bitcoin's down, or whatever time frame they want to kind of slap on whatever metric they're trying to produce. Like I can give you a metric that since the start of this year, Bitcoin's up 50% or whatever it is, 60%. Mm-hmm. So as you're choosing these time frames, you have to ask yourself, why did you select that period of time? Because I can go back to 2015 and give you a time frame to now, and Bitcoin's performance is a parabolic chart. So when you're comparing all of this fixed income financial jargon that we love talking about, right? But for not everybody in the room that's intimately familiar with the financial jargon, it can just sound like, what are they even talking about? The point that I would tell that person is, you go through these cycles, these governments step in, and when they're tightening the dollar or they're loosening the dollar, it's normally like a year and a half that they could tighten, 2 years that they can tighten. And then they're going to get exhausted, and then they're going to have to loosen. That loosening rate, though, if you look at it on a long time frame, like let's just take 10, 15 years, that loosening of the dollar is about 7 to 7.5% just for the dollar per year, if you did a compound annual growth rate on the M2 money supply. That's about 7 to 7.5%. What it appears is that rate is going to be persistent, if not accelerate, moving forward. So when we're comparing the dollar or the euro, which are the best fiat currencies, those are the best performing fiat currencies. So when you look at any other fiat currency, it's in excess of 7 to 8% annualized, right? So when you're looking at Bitcoin's performance, I would say at a bare minimum, without anybody else even coming into it, but just like sustaining the amount of people that are coming into Bitcoin, you should expect at a minimum that rate of return, because that's how fast they're debasing dollars in itself. You compound that with the sell-off rate out of fixed income, which is really kind of what we're getting at, right, with bonds, is the government is issuing debt at a pace that is outstripping reality. When you look at the tax receipts that we're collecting to pay for the issuance of the debt, it's accelerating. We're not dealing with 7 or 8% on the horizon for the coming 5 to 10 years. So when you look at Bitcoin, which has a fixed peg of 21 million coins at its terminal rate, and you're comparing that to this other system that is exponentially increasing in a bond market that they can't keep up with the issuance, that's the thing to focus on, because you can select whatever 6-month period of time or year time frame that you want to select out of that past performance, and you can jerry-rig whatever type of narrative that you want. But when you really zoom out and you look at the bigger picture, that's the thing for people to focus upon.
Yeah, Rafa, did you have anything to add from that? No?
Yeah, I think the only thing I'll add is that if we think about that, right, fundamentally about that, when money was created, it's the representation of proof of work that was done somewhere, right? So you worked, you received some money because you did that work, so it's the representation of your proof of work, right? When you start talking about that, and work that you did in the past up to the present, when you talk about that, you're actually, as Preston said, you become a slave because you're getting the debt today, you consume today, right? But then you have to do proof of work in the future to actually pay that debt today, right? And we live in a society that, you know, sooner and sooner is getting debt, right? People in my generation, I didn't see anybody getting debt at college, right? Now, debt at college is something normal. People are getting huge debts, right? Parents are getting debt to send their kids through kindergarten, which is mind-boggling stuff, right?
Yeah.
But that happens, right? So that work needs to be done somewhere, right? And I think people got used to this concept that, you know, you can get debt because, you know, the money also gets debased, which is something that shouldn't happen, right? Because the money is getting debased because someone somewhere can issue more of the money without any proof of work being done, right?
Yep.
And that completely disappears in a Bitcoin standard, right? We don't have that anymore, and that I'm confident that's going to fix a lot of problems that we have today.
Yeah, it reminds me of like Neil Kashkari when he was on 60 Minutes, when he had those big eyes saying, yep, trillions, trillions. And this panel is called Trillions of Reasons to Buy Bitcoin. Preston, you talked about time horizons. I think March 15th, 2020 is a very logical place to look at Bitcoin because that's when the Fed came out with all those facilities and suddenly they started adding trillions to the balance sheet. And if you look at the performance of Bitcoin since then, it's done pretty well. And you know, a lot of critics say it hasn't been an inflation hedge. I think that is a very logical place to look at Bitcoin's performance of how it's done over the last 3 years. And then you look at how bonds have done over those last 3 years. They're down 3 consecutive years. But you know, when we're at debt to GDPs at this level, last time it was around World War II. And the fiscal authorities basically tapped the central bank on the shoulder and said, hey, you guys are gonna follow us. We need your support to run these massive deficits to fund the war. We're gonna do yield curve control. But right now we have a central bank that's not you know, in cahoots with the federal government right now. They're actually doing completely opposite things. You got fiscal running almost $2 trillion fiscal deficit right now, but you have the Federal Reserve jacking interest rates trying to bring down inflation. Now, you have Jamie Dimon saying that interest rates could go to 7.5%, and already we're seeing the Treasury market start to kind of get shaky right now. Do you see a point where, you know, Fed independence is going to get challenged and the Treasury is going to tap Jay Powell on the shoulder and said, okay, cute with your you know, inflation target, but actually we need you to start to step in now. It's like, okay, now we're done here. Do you see that scenario coming out? Because I feel like a lot of traders went into the long end of bonds expecting the Fed to cut rates, to come in, but they've been waiting and it's been painful for them to wait for that trade. Do you think that's going to happen anytime soon, or do you see the Fed kind of digging in its heels to try to regain credibility?
The timing of saying when it's going to happen is somewhat of a fool's errand.
Yeah.
And mostly it's a fool's errand just because they have so many different tools. Like, was I expecting them to step in with the Silicon Valley Bank and provide a backstop facility so that all these banks never had to actually realize market forced prices on bonds and that they would just get par value for the bond? I did not expect that at all, right? Yep. And that one event with the 5 people sitting in the room to be able to step in and control that, what was a massive deflationary force that was trying to present itself into a quote unquote free and open market, just proved that it's nothing of the sort. And so when I'm looking at the situation right now, and if I put on my hat and say that we're in a free and open market, which we're not, then I would say, yeah, I think it's going to happen here pretty soon, and it's going to happen within 12 months. But who knows how long and what other type of manipulative ideas they can come up with. I know when you're looking at the repo, reverse repo situation, like it seems like they're bleeding that out, which maybe there's another 8 to 10 months of that they can kind of play with to provide liquidity into the market. So there's all sorts of things that they're going to continue to do. But with all of that said, this is the one thing that is happening in the background because of all those actions. You're gutting the middle class, you're gutting mid to small cap companies so that everything's getting consolidated into the hands of a couple. I know I've done quite a few interviews talking about this idea of like a forest, and you don't have this biodiversity in the forest. When you look at business, and you continue to exercise these manipulative forces, what you're actually doing is you're clawing out free and open market forces that add strength and make the economy robust, and you're making it more and more fragile by doing that. And so when you walk into a store and it seems like nobody's working, and you're like, how am I going to get a coffee, or how am I going to get lunch today? There's only 3 people in here working. All of those things that you're experiencing, and I'm sure you experienced as a young kid growing up, that everyone's seeing and is sensing is something's wrong. What's happening? I don't understand. What's happening is the manipulation in the free and open market is gutting everything, and you're getting a dominant species in that forest, or if it was like one like dominant predator, and there's no what's the word I'm looking for? Just natural competition inside the environment. When that's gone, you have inflation that's going to continue to manifest itself. And so that's what's happening when everybody looks around and they're just saying, what is happening? That's what's happening.
So, Preston, let me add 2 things to that. First, let me tell you a story about what happened in 2008. So it shows how the incentives were broken there, and I think it's even more broken now. So 2008, I was working at Merrill. So it was at the heart of the hurricane, you know. I remember on a Friday night, I went home, I got called by my boss, well, have to come back to work. You're probably gonna be working here the whole weekend. Merrill is being sold to Bank of America, right? So I go there, and I saw backstage how the deals were made, and that was complete government intervention from the top bottom, right? Ken Lewis was told at Bank of America that he needed to buy Merrill was going to go under, right? And I kept hearing people say that weekend, oh no, this is the Fed put we were all expecting, right? We're getting a government put, you know, and Merrill was saved. You know, all the executives, including myself, I'm ashamed to say that, but we got paid, right, that year. We got bonus that year, which shouldn't have happened, right, because the company went under. So the incentives are all broken, right? And when you talk about signs, you know, that I saw in my youth that, you know, unfortunately, it's anecdotal, but I'll tell you what I've seen. You know, I lived in the US 16 years. So then I went back to Brazil. So every time I come back, I see things that, you know, kind of like shock me every time. I'll tell you, I saw more people sleeping in the streets of Santa Monica in the last few days than I see in the streets of Rio. When I go to a drugstore in Rio, things are not locked up that you need to ask for a shampoo for someone to come in and unlock that for you, right? So the signs are everywhere. I think it's the frog on the slow boiling pot, right? So you don't feel it because it's one thing one day, the other thing another day. But I think for me, when I come here, you know, every 6 months, every 3 months, you know, the amount of drugs you see in the street, all of that, it shocks me. And it is happening, and that is direct consequence of a broken system, broken incentives, broken money, right?
I'm very hopeful with all of that said, because that sounds very doom and gloom, and like they're just going to keep pushing in this direction. I'm really hopeful that as there are financial products, and if we get a Bitcoin ETF, not that that's coming to save the day or in any shape of the imagination, but if Wall Street does start to allow spot products, they start allowing portions, let's say 1%, that's now part of a bond fund, and now people can get access to that through you know, whatever type of savings plans that they have, or that type of activity, by Bitcoin inserting itself into society in that way, can help out tremendously, because it actually starts to peg reality, which is proof of work, electrical cost, to have monetary units, to this made up imaginary, we're just going to keep adding more units at least 7 to 8% a year for the best US dollar currency relative to every other fiat that's out there. Bitcoin's going to start leaking itself into society. The pace at which it does that and the way that it does that is going to be whether we have a society where you have drastic social unrest, or it actually bridges to this new financial system in a nice, effective kind of way with the least amount of pain possible. And I'm very hopeful for the latter and not the former, and it's going to be totally up to how hard policymakers push for saving this, and I'm using the word in quotes, saving the legacy system. But if they start easing up and incorporating it, I think we're going to have a much better transition into the new financial system.
Yeah, and I think we are seeing a lot of that in Brazil. So let me tell you a little bit about the story of what we're seeing in Brazil in the present today, because I think it shows a lot of hope of where I think we're going with ending in Bitcoin. So about it was the end of 2020, Brazil installed something called Pix. So Pix is think about being something like Cash App or Venmo, but done by the central bank. So the central bank centralizes all the payments, works really well, so it is instantaneous. So you register your email address, say, okay, Rafa, send me some money, and I go there by your email address. Independent of where your bank is, you're going to see in your account immediately. So works really well. So adoption of Pix, it's probably among one of the fastest adoptions of technologies that we ever seen. To give an idea, there are like more than 600 million unique Pix keys that were created in Brazil, 150 million unique users using Brazil. There are 200 million in Brazil, so pretty much my daughter, 15 years old, she uses Pix. So everybody uses Pix, right? The typical ecosystem for the Brazilian today is WhatsApp and Pix. So somebody will send them their Pix address to receive a payment. All sounds great, right? Well, I'll tell you a story of something that I saw happen, and we see happen all the time. So I got a flat tire. I go change my tire. I change the tire, then I go fix the tire with the mechanic. And then I see a sign saying, well, we don't accept Pix. And that kind of struck me. I'm like, well, everywhere else you see people want to accept Pix and not credit cards, because credit cards, they have to pay fees to the credit card, merchant fees, on the credit card. Pix, they don't pay anything. It's free also. It's 100% free. So I asked him, like, well, what's happening? Why you don't accept Pix? It's so much easier. I can send you a Pix right now. And he tells like, well, last month I received a letter from Brazilian IRS that I owe them tax, and I don't have any money. This is probably, to give perspective, this is somebody probably makes, I don't know, less than $1,000 a month, right? So the IRS sends him a message saying, your accounts are frozen, can't use your accounts anymore. So he said, I don't have a bank account anymore. I can't use because of Pix, because the IRS now is cross-referencing the database of the central bank and monitoring. This is happening right now, right? I mean, you guys can go to Twitter and you're going to see, thousands and thousands of these stories. So think about it this way, right? We should be going in a direction that people are getting banked, and actually the central bank is promoting something where people are getting debanked. So I asked him, okay, so how do you want me to pay you? And he's like, well, I accept credit card again, cash, of course, is preferable, but nobody walks with cash anymore. So then he pulls his cell phone. He's like, oh, I actually can receive digital dollar. And I'm like, then I got struck, like, what is that? And he's receiving Tether. So, and I think and then I tell him about Bitcoin. Like, oh, so you receive Bitcoin, I'll pay you with Bitcoin. And he's like, no, I just prefer dollar because I understand dollar. But I think we're going through a natural progress of getting people from bad currency, which was the Brazilian real, to digital currency, still on the Brazilian real, to dollar, which is better than Brazilian real, but it's digital, right? Or physical, now it's digital. And this is opening the door. I think now, it's easy for us to say people should save in Bitcoin, these people should have Bitcoin. This guy doesn't have any savings, right, at the end of the day. Bitcoin is savings technology, I believe, before being payments technology. So it's going to take some time to that happen, but ultimately, this is going to happen, right? This is where this is going to end, because there's no way back. This guy's not going to be back using Pix anymore, right? Brazil is coming with their digital currency soon, and people are scared now because they know, it's programmable money, not in the right way, right? So I think this gives me a lot of hope. When I see kind of like this transition gradually happen, I think I know where this is going to stop at the end of the day.
Yeah, I mean, it's encouraging, like what Preston said, that we see kind of embracement of Bitcoin in a way. Narratives are starting to change as well. With the Bitcoin in the environment, you're starting to see some truth actually emerge out of these institutions in terms of the benefits that Bitcoin and Bitcoin miners can bring. And I think this performance this year has woken people up again. Like Bitcoin kind of rises from the ashes once again, and they're like, oh, maybe we have to rethink our approach to Bitcoin. But that's in the Western world. You actually see Bitcoin adoption happening most in countries that already have very unstable financial systems, very unstable monetary systems. The Lebanons, the Turkeys, the Argentinas, the Brazils, if you will. And I just saw a really interesting survey from Block that said that 88% of households that hold Bitcoin in this survey use it for remittance or send a lot of remittance payments. And Rapha, you brought up how stablecoin usage are high in Brazil. And I was just wondering what you guys think of kind of the rising stablecoins and how it can kind of relate to Bitcoin as well, because I saw a stat that in 2022, stablecoins settled over $11 trillion, which is about 10 times more than PayPal and almost as much as Visa. And so the rise of stablecoins is undeniable, and people want access to digital dollars, but it has the same risks as every fiat currency, which is debasement risk. But people want it right now, and I think we got to be realistic that Bitcoin's volatile. But how do you guys see this emerging? Because, like you said, the mechanic wanted digital dollars and didn't really know about Bitcoin yet. But obviously, Bitcoin's great for payments as well. So how do you guys see that all playing out?
I love the way that you put it, because it's showing the progression of your typical global citizen, right?
Yep.
Most people don't have access to the dollar. When you look at how most of the bills around the planet are denominated, they're denominated in dollars. So they're dealing with currencies that are atrocious. We were talking about how bad 7 or 8% debasement is annualized on the dollar. Well, a lot of these other currencies are 15% plus. And so when they're looking at how they want to pay their bills, of course they want a tokenized dollar. They could care less that it's on Tron or Ethereum or whatever, and that it's completely centralized. They just need because they're not using it as savings technology. They're using it for payments. They're using it to pay the bill that they owe in 10 days or 4 days or whatever it is. So they're not thinking in terms of savings technology. They're thinking in terms of payments. And what I think it's going to do is it's a slow orange pill to Bitcoin, because let's think about it. Over the last year and a half, in that person's mind, they're saying, well, Bitcoin hasn't outperformed the dollar, so I'm just going to continue to hold dollars, and I'm going to pay that bill that I owe in 4 days from now. But what happens whenever Bitcoin does surpass the dollar, the previous high, and that's in the news cycle, and people can choose between holding dollars or Bitcoin? You're going to start bringing more people over to hold that buying power in Bitcoin. Now, they're also looking at the volatility aspect of it relative to the dollar, but at a certain point in time down the timeline, that starts to get smaller, and they also are looking at the outperformance, and they're saying, well, that little bit of volatility is worth this outperformance. I'm going to continue to hold Bitcoins. And I think that's just a natural progression in training, if you will, of the global population of where this is all going. One other really thing to kind of hit back on the ETF comment that I made earlier, I think it's vital that when we're thinking about this, taking such a large treasury of Bitcoin in the future, because I fully expect it to be approved within the coming year. I fully expect there to be a substantial treasury in the billions at a BlackRock or an institution like that, which then are going to turn over and look at Coinbase as who they're filing with. And when I look at that, who owns the equity of Coinbase? Who controls Coinbase? BlackRock, the big banks, right? So I think that there needs to be extreme caution for all of our loved ones in this room, because I highly doubt people in this room are going to be using that product because you're smart. And I highly encourage everybody else to not be using a product like that, But that's not going to stop people from using a product like that.
No.
People need a turnkey, because they just can't do the work. They don't technically understand it. And so I think there needs to be a huge push on the education front as to who's custodying these coins, what are they doing with these coins, who's controlling the equity of the individuals that are controlling these coins. And we shouldn't just like roll over and say, oh, yay, the price went up. It's an ETF. It's all good. No, I think we need to continue to push very hard on the education front. And if there's policy that's needed to make sure that it's one-to-one matched, it's in something that can't be controlled by any single entity, well, we need to push for whatever that is.
And I think, when we look at the ETF, right, as you said, I think it's going to require a lot of education because it's easy, right? People are going to buy that instead of buying the real asset. And, let me be very clear. There's no second best. The best thing is to hold your own Bitcoin with your own keys, right? That it's there. You can see in the blockchain exactly where it is. But definitely, it is easier. People buy TLT instead of buying treasuries, right? Even though buying treasuries is very, very easy, they still buy the ETF because it's easy. It's there. It's their brokerage account. But similar, I think, to what we are seeing with digital currencies and people going to Tether and then ultimately going to Bitcoin, I think it's going to be the same way. It's a gateway. People are going to go there. The volatility is actually, people love volatility. They say they don't like volatility. On the upside, they love volatility, right? They don't like volatility on the downside. When it goes up, 10, 20% in their face, they love it. So when we go to the next peak, which we will, and they have the ETF, right, that's the right people are going to go there, they're going to understand what they really hold, then you have the incentive to really learn about Bitcoin, and I think everybody's going to get at the end game, which is holding your own keys and holding your own Bitcoin.
Yeah, we just have to educate about the trade-offs, right? It's convenient, it's nice, but it's nothing like holding spot Bitcoin. There's counterparty risk, and if you read the S1, you don't have a lot of rights when you own shares of that ETF. You should probably read that, and as well as the fees, obviously, that you have to pay every year for the sponsor to run that. So obviously, in ETF, there's a lot of, I'd say, some debate going on about these paper Bitcoin products and how they could potentially, affect the price of Bitcoin, suppress it. There's all this manipulation talk. And Rapha, I know that you have experience working in derivatives at Merrill Lynch for a long time, and so I wanted to get your thoughts about, the potential of that happening, somehow these paper products affecting the Bitcoin price. How do you see those arguments?
Yeah, there's definitely price manipulation, I would say that. But I think when people talk about price manipulation, they usually think about, other players using futures and using derivatives to manipulate price. I think up until now, most of the price manipulation we've seen, unfortunately, has been fraud. People are using Bitcoin that it's not their Bitcoin. Because when you look at derivatives, right, if I do a derivative transaction, the risk has to be somewhere, somehow, right? If I do a transaction with you, I'm going to be long Bitcoin, you're going to be short Bitcoin, or the opposite. So you're either going to take the risk that you're short Bitcoin, or you're going to offset that risk with somebody else, right? Because you don't want to be, the risk, it's going to end up somewhere. Someone is going to have to pay someone, is going to have to pay someone that you have to pay me, or you have to live with the risk, right? So the risk doesn't die, it's there somewhere. So when people say, well, they're engaging in futures and they're manipulating, you can't manipulate too long because if you're shorting Bitcoin, right, and Bitcoin goes up in your face, you're going to have risk, right? So there's market risk there. So I don't think there's a lot of manipulation that happens in derivatives. There's definitely a lot of manipulation that happens for fraud. People selling Bitcoin that it's, like we saw with FTX, right? They pretty much didn't have any Bitcoin. Yeah. And it's funny, right? They held a lot of other shitcoins, but they didn't hold any Bitcoin, right? Because that's the most liquid asset. That's the one that's easiest to sell, that has the better price. And there was some manipulation there, as we saw with the double peak and all of that, right? But that's also limited because at some point you run out of Bitcoin, right?
And that's the point. At some point, you're going to run out of Bitcoin. You got two forces. You got the hodlers that are looking at it as a savings technology. They just buy it, they buy more, and then they buy more after that, and they keep putting it into their savings because they're net producers, and they're going to continue to be net producers, and they're going to keep buying more. Then you have speculators, people who are trying to trade around it and they're trying to make a quick buck, and then they're trying to do it again by looking at whatever technical factor they're saying is driving their decision tree. When I think about people that make a strong case for derivatives are going to continue to manipulate Bitcoin, I would say, A, they don't understand why this is very different than gold and why you're or any type of difficult to settle commodity or take physical custody of. And when I look at Bitcoin, it's drastically different. And those long-term hodlers, as they continue to buy more and more and stack it in cold storage and the price reacts, if you're trying to manipulate that, you're going to lose the coins off the exchange at a certain point, and the price in the spot is going to drive and wag the tail of that speculator. Yeah. So this is an argument between long-term buyers and holders and people that actually understand what they're owning and not taking paper Bitcoins. They'll refuse all day long because they actually understand what they're buying, versus somebody who's a speculator that's in the market for a couple days, couple hours, couple seconds, and they're trying to say that it's going to be manipulated for the long term. Going back to that, a lot of arguments come down to timeline that you're saying that it's going to happen. I'm looking at this from a 5 to 10 year period of time, not what's going to happen tomorrow or next week.
Right. Yeah, I mean, I would say that, what I would say the biggest consequence of the spot Bitcoin ETF would be is that it's going to take funds away from those paper derivatives, futures, Bitcoin contracts, and it's going to go into either a spot Bitcoin ETF or spot Bitcoin. And that the biggest difference, like you mentioned, is the volatility of Bitcoin makes it extremely difficult for the speculators who are trying to suppress it, and then the ease of self-custody. So great comments, Preston. Rapha, we're out of time right now, guys, so thank you so much for listening, and why don't you give these two a round of applause. Thanks so much, guys. It was so much fun.
Thank you.